Let's look at a couple of corporate stories that we've been tracking through the course of the day, and this is the latest in the Jet Airways resolution plan. In a CNBC-TV18 exclusive, we're learning from sources the airline needs 10,605 crore rupees for sustainable operations. Anu Sharma is joining us now to tell us how exactly they're going to get this money together. Anu?
In Jet Airways matter, the lenders are to rescue the airline in case they are unable to find a single investor to buy. Airline would need a total 645 crore rupees. That is what we got to know from a review of the draft plan. Now, the plan B lists sources to raise the sum. First step requires all shareholders to transfer a part or entire stake to an independent trust. The trust will be managed by trustees appointed by the lenders, and the lenders will have a call option on the shares owned by them at 150 rupees per piece. Equity infusion of around 5,135 crore rupees will be done through rights issue. This will bring two new in complete exit of Naresh Goyal and Etihad. Secondly, 2,400 crore rupees loan will be provided to help in refinancing of planes. And the third step will be 2,000 crore rupees in non-fund based facilities. Now, after this, draft plan directs the domestic lenders to write down their entire debt of 2,600 crore rupees, and foreign lenders are required to take a haircut of 1,170 crore rupees. The plan does not ask for any write-down by lessors and other creditors. Overall, lenders are hoping to achieve gains of over 2,600 crore rupees by March 2022, assuming that the share price of the company reaches the levels of around 300 rupees per share by that time. So, at the end of Plan B, we are looking at Jet Airways 30% owned by lenders, 20% and 25% by the two new investors, 15% by the trust, and remaining 10.7% of public shareholding. Now that a backup plan is in place, it remains to be seen whether the first plan takes off. Consortium of lenders is expected to invite expressions of interest for stake sale in Jet Airways on April 9th. But one key point for the airline, whether it goes ahead with Plan A or B, will be its ability to retain key landing and takeoff slots at major airports. Back to you.
Okay. All right, Anu, thank you very much for that. So let's see. That is what Anu is right now picking up in terms of how the alternate plan could work out to get that sum of money together. Let's move on now. As India's first REIT made its debut on Dalal Street today, our colleague Ritu Singh caught up with Jitendra Virwani, Chairman and MD of the Embassy Group, as well as Vikram Garg, Managing Director of Blackstone India, to understand their view and the expectation that they have from the Indian rental market. Here's what they're saying in terms of the market ahead and what they will do with the proceeds of this issue.
So we're actually very satisfied, but in some ways disappointed that more of them couldn't get in because of lack of time. But I think we had a great response from the retail investors. I think we were 3 times oversubscribed as far as retail investors are concerned.
Okay, how will the proceeds of this be used, if you could give us a breakup?
I think the 4,750 crore that we're raising will essentially go down to pay the debt at the SPV levels. Yeah. And there is actually both G2 and Blackstone are not selling anything at this time.
Could you tell us where the debt exactly stands and how you're looking to pair that to what level, if you could give us a time horizon?
Sure. The debt today, as it stands at the 11, so to say, companies, today stands at roughly 8,000 crores. The 4,750 from the IPO proceeds, along with a bond that we're raising at the REIT level, we essentially use to repay the debt. Post-listing will be approximately 12% LTV, which is a very low leverage company.
All right. You're listing about 33 million, worth of assets. We understand about 9 million is still under construction. Could you give us a timeline by when that would be completed?
This, I think, approximately would be in the next 24 months to 30 months. Most of the assets will be completed.
Okay. And are you looking to...
I mean, we're allowed actually 20% under construction, but, we have only about 13% so far.
Yeah, I think the 2.5 million, which is currently under construction, will get done in the next 2.5 years. I think the 5.5, which is still in land stage, I think will depend on how the demand and supply situation.
Are you looking to add more assets to this portfolio, say over the next year or more?
I mean, at this point, I can't really comment, but of course, I mean, the whole idea is that the REIT would get more assets, but we would be definitely putting more assets. But right now, which asset we have not really looked at it because we want some of the under construction to start finishing.
Okay, let's talk about a 5-year horizon. What would the asset size look like from 33 million currently to?
I think it's going to be very difficult to predict. I think we obviously see this as a very positive vehicle to be able to acquire third-party assets, but it's difficult to at this stage comment on size.
But what sort of yield could you promise your investors at this point?
I think this, if you understand the product, I think this is not a promise, but I think we are, as you laid out in the prospectus, the first year dividend yield that we're looking at 8.25 on a quarterly basis stacks up to an 8.5. I think if you look at year 2, that goes up to an 8.9. I think at this stage, but I think more importantly, I think what you got to understand is there is potential for capital appreciation, and that's coming through in the form of rental growth in the underlying assets. So I think it's important that people understand the growth levers of the portfolio, which is essentially your escalations that you the 5% every year or 15% every 3 years, the mark to market and the development. So I think, and that's going to be when people recognize that and see that coming through, I think that's going to be the big game changer.
SEBI is looking at making some changes in the REIT structure. Perhaps lot size could be reduced. Do you think that could potentially lead to more price fluctuations for you?
Not really. And we're also, I wouldn't like to comment on what if SEBI is doing there, but I think that it really, at this stage, I think it's more the existing REITs to come in and stabilize, and then I think something should be looked at further ahead. But right now, I think it's just what the rules are. They're perfectly fine, and I think we're quite happy with it.
Would you like to?
Yeah, I think, lot size going down, I think will help. I think retail participation will increase as and when people understand the product. I think it'll help, it'll actually help allow retail investors to participate. So.
Would Blackstone look to add more products to this portfolio from your other partners, developers that you've been in talks with?
I think let's wait and watch. I think clearly we want this to do well. We want to deliver on the numbers. I think whether it be Blackstone or other third-party owners, we'd like the REIT market to develop, and that the onus is on us to continue and develop, to educate both investors as well as the regulator on how this does.
Just one last question to you. In the case of InvIT listing, there are hardly one or two. We've seen from where they're trading now, from the issue price, a significant drop. You think there'll be a better response to REITs now, perhaps with more understanding in the markets?
So it's all more about understanding the product. We're two different products, actually. Yeah. The one is diminishing in their asset value, and one is appreciating in their asset value. So I don't think actually the whole idea of being compared itself is not relevant. So I think that people need to get educated, and probably the bankers, wealth managers need to do a better job on that.